UK economy stagnates. Challenges mount for Labour government. The United Kingdom faces a tough economic crossroads as the Office for National Statistics (ONS) confirms that growth in the third quarter has stagnated, with figures revised down from 0.1% to 0%. This troubling news arrives as a significant challenge to the Labour government, which took office on July 5 with promises to prioritise economic growth. The stagnation, driven in part by weaker trading in bars and restaurants, raises questions about the government's policies and their impact on the UK's financial stability. In this report, we'll unpack the key factors behind the stagnation, the criticisms levelled at the Labour administration, and the broader implications for businesses and households. Economic stagnation. A troubling reality. The ONS's revised data paints a concerning picture of the UK economy, showing no growth in the third quarter. Initially estimated at a modest 0.1%, this downward revision highlights underlying weaknesses. A notable factor contributing to this stagnation is a decline in consumer spending, particularly in the hospitality sector. Bars and restaurants, which typically thrive on consumer confidence, have reported weaker than expected trading, reflecting broader economic pressures. Adding to the strain, Treasury Chief Rachel Reeves's October budget introduced higher taxes on businesses. While intended to raise government revenues, this move has reportedly led to unintended consequences. Many businesses, already grappling with inflation and rising costs, have passed the burden on to consumers through higher prices or scaled back operations by reducing staff and wages. The result is a squeeze on both businesses and households, deepening the sense of economic uncertainty. The stagnation also raises alarms for Labour's broader economic agenda. Having inherited a recovering economy previously recognised as the fastest growing in the G7, Labour's leadership is now under scrutiny for failing to maintain momentum. Critics argue that their policies, combined with a pessimistic narrative about the economy, have eroded confidence and worsened performance. Criticisms and challenges for Labour. Critics from the opposition, particularly Conservative economy spokesman Mel Stride, have been quick to highlight Labour's perceived missteps. Stride points to the government's handling of the economy since taking office, emphasising the contrast between the previous G7 growth ranking and the current stagnation. According to Stride, Labour's portrayal of the economy as broken upon taking office may have deterred investment and consumer confidence. Reeves's decision to increase business taxes has also faced backlash. Economists warn that the higher tax burden discourages entrepreneurial activity, limits job creation, and reduces wage growth. Small and medium enterprises (SMEs), which form the backbone of the UK economy, appear particularly vulnerable to these changes. Critics argue that without targeted support for these businesses, the economy may struggle to regain momentum. Labour's leadership is now faced with a delicate balancing act, reviving growth while addressing criticisms of overregulation and high taxes. To do so, they will need to inspire confidence in their economic policies while taking tangible steps to reverse the current trends. The government's ability to navigate these challenges will be pivotal to their credibility and the country's financial outlook. Implications for businesses and households. The stagnation of the UK economy has tangible consequences for everyday people. With businesses raising prices or cutting staff due to increased taxes, households are feeling the pinch. Rising costs in essentials from groceries to utilities mean that disposable income is shrinking, leaving less room for discretionary spending in areas like dining out or entertainment. This, in turn, perpetuates the cycle of economic stagnation as consumer demand weakens. For businesses, particularly those in the hospitality and retail sectors, the environment remains challenging. Many are grappling with reduced foot traffic and higher operating costs, forcing them to adapt or risk closure. The ripple effects are being felt across supply chains, with vendors and service providers also experiencing decreased demand. In the broader context, the stagnation underscores the importance of fostering a balanced economic strategy. Experts argue that a focus on incentivizing growth, through measures such as targeted tax cuts, infrastructure investments, or innovation grants, could provide a much-needed boost. Without these measures, The UK risks falling further behind its global counterparts in economic recovery. The UK's economic stagnation in the third quarter is a wake-up call for the Labour government. Faced with the dual challenges of restoring growth and addressing public confidence, their next moves will be critical. From revisiting tax policies to implementing targeted support for businesses and households, there is much work to be done to steer the country back on track. As the UK navigates this uncertain period, it's essential for policymakers, businesses, and citizens to remain engaged in the dialogue around economic recovery. We encourage you to share your thoughts and ideas for revitalizing the UK economy. Stay informed by following our updates, and join us in tracking the steps taken to overcome these challenges. Together, we can better understand the path forward.
Global economy faces uncertain future amid emerging challenges. As the world moves into 2025, the global economy is transitioning from post-pandemic recovery to navigating an increasingly complex landscape. While central banks have managed to lower interest rates and stock markets soared to record highs in 2024, underlying economic challenges remain. A cost of living crisis, geopolitical conflicts, and policy uncertainties are reshaping the global economic outlook. In this report, we explore the key factors driving this turbulence, the potential consequences for nations and individuals, and the steps policymakers must consider to stabilize the global economy. Post-pandemic recovery. A mixed bag. The economic rebound following the COVID-19 pandemic showcased both resilience and disparity. On the surface, declining interest rates fueled stock market rallies, benefiting investors and corporations. However, the broader population has not reaped the same rewards. Many households are grappling with rising costs in essentials like housing, food, and energy, creating a cost of living crisis that has left voters in wealthier nations disillusioned. This dissatisfaction has led to political shifts in several major economies, with leaders prioritizing immediate voter concerns over long-term stability. Meanwhile, poorer countries have largely been excluded from the benefits of the global recovery. Limited access to vaccines, infrastructure investments, and international aid has left them struggling to regain pre-pandemic growth levels. For richer nations, shifting spending priorities further complicate recovery efforts. Governments face pressure to address climate change, healthcare, and social equity while contending with ballooning deficits. The challenge lies in balancing these demands without exacerbating inflation or curbing growth. Geopolitical tensions and economic risks. Geopolitical instability continues to cast a shadow over the global economy. Potential U.S. import tariffs under a Donald Trump presidency threaten to ignite a new trade war, raising inflation and unemployment worldwide. Historically, such measures have disrupted global supply chains, leading to higher prices for consumers and reduced export opportunities for businesses. If enacted, these tariffs could undermine the fragile economic recovery. Conflicts in Ukraine and the Middle East further add to economic uncertainty. Rising energy prices, driven by supply disruptions, impact both developed and developing nations. Europe faces additional challenges, with political gridlock in Germany and France stalling much-needed reforms in the EU. China, often considered the engine of global growth, is grappling with its own economic concerns. Slowing growth, a real estate crisis, and mounting debt have raised questions about the sustainability of its economic model. For countries heavily reliant on Chinese trade, this poses significant risks. The IMF's warning and policy imperatives. The International Monetary Fund (IMF) has issued a stark warning about the challenges ahead, urging global policymakers to prepare for a turbulent year. Key recommendations include fostering international cooperation, prioritizing investments in infrastructure and clean energy, and addressing inequalities exacerbated by the pandemic. For poorer nations, targeted financial aid and debt relief could help bridge the gap and support sustainable development. Richer nations must also rethink fiscal policies to ensure spending is both strategic and inclusive, avoiding measures that could disproportionately impact vulnerable populations. One potential bright spot is the continued advancement of technology and innovation, which offers opportunities to drive economic growth. However, realizing this potential will require significant investments in education, research, and infrastructure to ensure equitable access. The global economy stands at a critical juncture, facing challenges that will require collective action, innovative solutions, and resilient leadership. From cost-of-living crises and geopolitical tensions to policy uncertainties, the path ahead is fraught with complexity. Yet, with coordinated efforts and a focus on inclusivity, there is hope for navigating these challenges effectively. As individuals, we can contribute by staying informed, advocating for responsible policies, and supporting sustainable practices in our communities. Join the conversation. What do you think are the most pressing issues for the global economy in 2025? Share your insights and stay tuned for more updates as we track the evolving economic landscape. Together, we can better understand and prepare for the challenges ahead. China's financial markets brace for another year of volatility in 2025. China's financial markets are gearing up for a turbulent 2025, as economic challenges continue to mount. Despite aggressive efforts by Chinese officials to stabilize the economy through interest rate cuts, monetary policy shifts, and a significant fiscal package, consumer confidence remains low and economic growth sluggish. Adding to the uncertainty are potential U.S. tariffs under the incoming Trump administration and a struggling domestic property market. In this report, we explore the factors driving market volatility, China's strategic responses, and what lies ahead for investors and the global economy. The state of China's markets. A fragile recovery. China's financial markets have seen some recovery in 2024, with the iShares MSCI China ETF rising 17% this year. However, this rebound comes with a caveat. Stocks remain down more than 40% from their peak in 2021. This significant gap reflects lingering weaknesses in consumer confidence and economic growth, underscoring the challenges Chinese policymakers face. The domestic property market is one of the biggest drags on the economy. Saddled with debt and plagued by declining property values, the real estate sector continues to weigh on consumer spending and broader financial stability. Many Chinese households hold much of their wealth in real estate, meaning a downturn in this sector directly impacts their financial security. China's reliance on exports further complicates the picture. Trade tensions with the U.S., exacerbated by potential tariffs under the Trump administration, threaten to disrupt supply chains and increase production costs. While the Chinese government has implemented policies to boost domestic consumption, their impact has been limited so far, leaving the economy vulnerable to external shocks. Strategic responses and global implications. To mitigate these challenges, China is expected to unveil new fiscal measures at the upcoming National People's Congress. Analysts are closely watching for targeted stimulus aimed at revitalizing consumer spending and encouraging domestic investment. However, structural reforms, such as enhancing transparency and reducing dependence on exports, will be essential for sustaining long-term growth. China's strategic responses are also shaping global markets. For instance, the country has hinted at imposing restrictions on key materials essential for tech manufacturing, a move that could disrupt global supply chains and escalate trade tensions with the U.S. Additionally, tighter regulations on companies like Nvidia could have ripple effects across the tech industry, influencing investor sentiment worldwide. Despite the challenges, there is cautious optimism for 2025. Targeted stimulus measures and policies aimed at driving consumption-based growth could stabilize the economy in the short term. However, the road to sustained recovery requires addressing deeper issues, including the debt-laden real estate sector and structural inefficiencies in the economy. Looking ahead, risks and opportunities. China is better positioned to weather economic turbulence than in the past, thanks to a more diversified economy and stronger policy tools. However, significant risks remain. The combination of domestic challenges, such as weak consumer confidence and a sluggish property market, and external pressures, including trade tensions and global market volatility, makes for an unpredictable 2025. For investors, understanding these dynamics is crucial. While short-term opportunities may arise from market fluctuations, long-term confidence will depend on China's ability to enact meaningful reforms and maintain stability. Upcoming announcements at the National People's Congress will be pivotal in shaping market expectations and determining the trajectory of China's economy. The global implications of China's economic strategy cannot be overstated. As the world's second-largest economy, China's policies and market conditions influence everything from commodity prices to international trade flows. Stakeholders across industries will need to stay informed and adapt to the changing landscape. As China navigates another year of market volatility, the stakes are high not just for its economy but for global financial stability. With challenges ranging from domestic economic struggles to geopolitical tensions, the road ahead is fraught with uncertainty. However, with targeted policies and structural reforms, China has the tools to chart a path toward recovery and resilience. For investors and businesses, staying ahead of these developments is essential. Monitor announcements from the National People's Congress, watch for shifts in trade policy, and assess the impact of China's strategic decisions on global markets. Join the conversation. What do you think will shape China's economic future in 2025? Share your thoughts and stay tuned for updates as we track this critical story. Grim economic outlook divides Americans despite favorable indicators. As 2024 draws to a close, a recent APNORC poll reveals a striking paradox in the United States. Despite favorable economic metrics, such as a low unemployment rate of 4.2% and a surging stock market, public sentiment about the economy remains overwhelmingly negative. About 7 in 10 Americans describe the economy as poor, with perceptions deeply divided along political lines. Democrats express heightened pessimism following Donald Trump's return to the presidency, while Republicans hold a more optimistic view, anticipating improvements in 2025. In this report, we explore the factors driving these sentiments, the role of political affiliations in shaping economic perceptions, and the challenges ahead for the newly elected administration. Favorable metrics, grim sentiments. From a purely statistical standpoint, the U.S. economy appears to be in good shape. Unemployment remains near historic lows at 4.2%, reflecting a strong labor market. The stock market has shown consistent gains throughout the year, buoyed by investor confidence and corporate earnings. Yet, for many Americans, these indicators feel disconnected from their day-to-day realities. One major concern remains inflation. While it has eased from its peak in previous years, elevated prices for essential goods and services continue to strain household budgets. Many Americans are struggling to meet basic needs and year-end expenses, creating a disconnect between positive economic headlines and lived experiences. For a large portion of the population, particularly those in lower-income brackets, the benefits of a booming stock market and low unemployment are overshadowed by the persistent cost of living crisis. Adding to this disconnect is the psychological impact of political transitions. With Donald Trump's election victory, Democrats are more inclined to view the economy negatively, even as economic conditions remain stable. This illustrates how perceptions often reflect political affiliations rather than objective economic realities. Political divides shape economic perceptions. The APNORC poll highlights the stark divide in economic sentiment along party lines. Among Democrats, pessimism is at its highest, with many expressing concerns about the impact of Trump's policies on social equity and long-term stability. In contrast, Republicans are optimistic about the prospects of economic growth under Trump's leadership, citing his previous tenure as evidence of his ability to stimulate the economy. This polarization underscores how economic perceptions are not merely shaped by data but by broader political narratives. For Democrats, Trump's focus on tax cuts and deregulation is seen as prioritizing corporations over ordinary Americans. Republicans, however, view these policies as catalysts for job creation and investment, fueling their optimism for 2025. For Trump, the challenge lies in bridging this divide and translating his economic policies into tangible improvements that resonate with all Americans. His administration faces the dual task of addressing inflationary pressures while demonstrating that growth metrics can translate into broader economic relief. Challenges for Trump's presidency in 2025. While Republican optimism provides a political tailwind for Trump, delivering on economic promises will require navigating significant challenges. Inflation, although improving, continues to erode purchasing power, particularly for middle and lower-income families. Restoring public confidence in the economy will necessitate targeted measures to address affordability, such as tax relief for working families or investments in affordable housing. Additionally, the polarized political landscape poses obstacles to implementing cohesive economic policies. Legislative gridlock, fueled by partisan divisions, could hinder efforts to pass critical reforms. For Trump, success will depend on his ability to build consensus and demonstrate that his policies can benefit a broader swath of Americans. Economic sentiment will also be influenced by global factors, such as trade relations and geopolitical stability. Trump's return to the presidency has already sparked speculation about potential shifts in trade policy, which could impact inflation, jobs, and economic growth. Balancing these domestic and international dynamics will be crucial for maintaining economic momentum. The stark divide in Americans' economic outlook as 2024 ends reflects the complex interplay between statistics, lived experiences, and political affiliations. While unemployment is low and the stock market thrives, persistent inflation and concerns about affordability weigh heavily on public sentiment. For Donald Trump, the challenge lies in translating positive economic indicators into widespread confidence and addressing the concerns of a deeply divided populace. As the nation navigates these uncertainties, staying informed is more important than ever. Join the conversation. What do you think are the key challenges and opportunities for the U.S. economy in 2025? Share your thoughts below, and follow our updates for the latest insights on how policy decisions impact everyday Americans. Together, we can better understand the forces shaping our economic future. Australia's economy poised for recovery in 2025. Can growth balance inflation risks? Australia's economy is showing signs of recovery as 2025 approaches, with the International Monetary Fund (IMF) projecting growth to accelerate from 1.2% in 2024 to 2.1% next year. After a period of sluggish performance, the country appears to be navigating a path toward a soft landing, a scenario where inflation is controlled through higher interest rates without triggering a recession. However, challenges such as rising unemployment, weak household consumption, and global trade disruptions remain key risks. In this report, we break down the drivers of Australia's recovery, the risks flagged by the IMF, and the strategies needed to sustain economic stability. A path to recovery. Growth drivers in 2025. The IMF's optimistic projection of 2.1% growth in 2025 is underpinned by several factors. Real income growth is expected to play a crucial role as Australians benefit from improved wages and lower inflationary pressures. Additionally, upcoming tax cuts are poised to boost private consumption, encouraging households to spend more on goods and services, thereby stimulating economic activity. Public demand remains a strong pillar of growth, with government spending on infrastructure and social programs continuing to provide a steady economic boost. Australia's robust export market, particularly in commodities such as iron ore and liquefied natural gas, is also expected to contribute to economic momentum, despite global trade uncertainties. Treasurer Jim Chalmers has emphasized the government's commitment to balancing these growth drivers with policies aimed at curbing inflation. This involves maintaining current high interest rates to temper excess demand while ensuring fiscal measures do not overheat the economy. Risks and challenges. Inflation and global pressures. While the outlook is positive, The IMF has cautioned against complacency. Rising unemployment, a potential consequence of prolonged high interest rates, poses a significant threat to household consumption. Weak spending could undermine the recovery, especially if wage growth fails to keep pace with inflation. External risks, including global trade disruptions and geoeconomic tensions, add another layer of uncertainty. As a trading nation heavily reliant on exports, Australia is vulnerable to shifts in international demand and supply chain disruptions. Any significant slowdown in key markets such as China could ripple through the Australian economy. The persistence of inflation remains a central concern, particularly given the tight labor market. A scarcity of skilled workers has driven up wages, which, while beneficial for households, could also contribute to prolonged inflationary pressures. The IMF has urged Australia to reprofile public infrastructure investments and better target transfer programs to mitigate excess demand and ensure that fiscal policies are aligned with monetary tightening. Policy recommendations and the road ahead. The IMF has laid out a clear roadmap for sustaining economic recovery while addressing inflation risks. They recommend keeping current high interest rates in place to stabilize prices, coupled with cautious fiscal policies to avoid overheating the economy. Reprofiling public infrastructure investments, shifting funds to projects with immediate economic impact, could help balance short-term growth with long-term stability. Better targeted transfer programs, such as more precise social benefits for vulnerable populations, are also essential. These measures would ensure that fiscal support is directed where it is most needed, reducing the risk of excess demand while protecting those most affected by rising costs. Treasurer Jim Chalmers has voiced support for these strategies, highlighting the government's dual focus on managing inflation and fostering sustainable growth. By addressing these challenges head-on, Australia could achieve its soft landing, setting an example for other economies navigating similar post-pandemic dynamics. Australia's economic outlook for 2025 offers a mix of optimism and caution. With projected growth of 2.1%, the country appears to be on the path to recovery, driven by real income growth, tax cuts, and robust public demand. However, challenges such as rising unemployment, persistent inflation, and global trade risks underscore the need for careful policy management. As Australians prepare for the year ahead, staying informed about economic trends and government policies is more critical than ever. What are your thoughts on Australia's recovery strategies? Do you believe the country can achieve a soft landing? Share your insights below, and follow our updates for the latest on Australia's economic journey. Together, we can better understand and navigate the challenges shaping our future.